detailed investment analysis on Riot Platform's Q3 2025 massive earnings beat. It's all driven by higher Bitcoin prices and their big strategic expansion into AI and high-performance computing.
Yeah, and it's an immediately compelling report. I mean, the author does a really effective job showcasing that 26-cent EPS beat.
For sure.
And at the same time, they're setting up this complex narrative of the company's pivot from just a pure Bitcoin miner into an infrastructure-heavy giant. It's a very strong piece of work right out of the gate.
I completely agree. That shift from a loss to, $104 million profit? It's astounding.
It is.
But, reading deeper, I was struck by how much of that headline number really relies on certain financial mechanisms. So I think we should look closely at the financial structure of that profit flip.
Okay.
Between, operational performance and accounting gains it's everything.
That emphasis is absolutely the right place to start.
So it's maximize this material's intellectual honesty and its appeal to those sophisticated investors. That distinction between operational earnings and the non-cash accounting gains, it really should be sharpened immediately.
Right up front.
The report, it accurately points out the significant swing from that $154.4 million loss in Q3 2024 to a $104.5 million profit in Q3 2025. And it says it's largely due to the required fair value accounting of their massive Bitcoin holdings.
Right, and I see that point. I think the weakness here is that this crucial nuance, it's buried just a little too deep in the detailed financial section.
A little bit, yeah.
And the risk is that the really impressive immediate headline EPS number, the 26 cents, it just completely overshadows the actual core operational performance story. For the serious investor, especially those focused on valuation multiples, they want to understand the quality of the earnings. Is this a cash-generating machine, or did they just benefit from an asset appreciating on the balance sheet?
And both stories are compelling, but they serve different analytical
Totally different purposes, yeah.
purposes. So the suggestion, I think, would be to resequence the presentation of profitability. You need to clearly prioritize the operational engine before introducing the one-time or unrealized accounting impact.
Yes.
This avoids any perception that the profit flip is purely a paper gain, which, it often triggers skepticism.
Exactly. You want to lead with the fundamentals, not the fluctuation. I mean, we should probably use the adjusted EBITDA figure of $197.2 million.
The record high.
That's it. It's a record high, and it serves as a primary indicator of core operational strength, efficiency, real margin expansion. When you tell a sophisticated audience, hey, they crushed it operationally, achieving nearly $200 million in adjusted EBITDA, that changes the entire conversation.
And it might be good to provide that quick context for those less familiar with the term. Adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization. It's the clearest metric here.
Because it strips out all the non-cash items.
Right, and debt servicing. It just shows what the core mining operation is truly generating. That's the crucial number.
And it is a stunning number. Almost unbelievable for a miner. It just shows the underlying efficiency is massive. That's the real story they should lead with.
So we could then use the $93.3 million increase in Bitcoin mining revenue, which fuels that 112% revenue surge, as the natural bridge.
Okay, I like that.
This shows the operational growth. And then we introduce the net income and EPS, but we contextualize them as being significantly amplified by the appreciation of their existing 19,287 BTC treasury.
Which, under fair value rules, they have to mark to market.
Exactly.
That framing is perfect. We move from operational success to strategic advantage. We should suggest framing it directly, maybe at the top of the financial analysis, something like, the operational machine delivered $197.2 million in adjusted EBITDA, demonstrating core profitability. And that success was compounded by the strategic advantage of their massive $2.2 billion BTC treasury, which provided the fair value boost to net income.
That elevates the quality of the analysis instantly. It shows the operational engine is sound, regardless of market volatility.
It really does.
That's a great example. Okay, moving on, let's look closely at the section discussing the transition from mining success to the AI future. The material really needs a stronger narrative connective tissue. It has to unify the immediate financial victory with the long-term ambitious AI diversification strategy. That's what cements the true double-threat investment thesis.
I noticed that separation too. The current flow presents these operational powerhouse stats, the 1406 BTC mined, the high hash rate.
All the good stuff.
all the good stuff, and then it pivots really sharply to the future outlook, the AI pivot. And suddenly we're talking about the 112 megawatt Corsicana expansion and the 2 gigawatt power pipeline.
The weakness there is that this abrupt segmentation, it risks making the aggressive expansion plans, this huge move into stable, high-margin data center leasing, seem almost
Aspirational.
right, like a dream. Yeah, instead of being directly funded by the Q3 success. If they are an infrastructure giant, the report has to show how that infrastructure is being paid for.
Exactly. If the mining business is strong enough to fund the AI pivot without relying on debt or dilutive equity raises, I mean, that is a definition of a double threat.
It is.
So the suggestion for improvement here is to explicitly leverage the Fortress balance sheet data points, specifically the $2.2 billion in Bitcoin holdings and that $330 million cash on hand.
Make that the primary self-funding engine.
Yes, the thing that validates this whole aggressive growth phase.
So we're basically shifting the focus of the BTC Treasury from just being an accounting boost in our first critique to being the strategic engine of growth in the second one.
And building on that point, we need to show how that capital is generated and deployed. So in the transition section, we have to make the connection unmistakable.
Like how?
Well, the ability to self-fund the 112 megawatt Corsicana core and shell development, which analysts have noted, that's the direct strategic advantage.
Derived from the profitable mining operations.
And the appreciating treasury. It demonstrates total independence from external financing, which is a massive differentiator in such a capital-intensive industry.
That is powerful. We should reframe the operational success section, Section 3, not just as production, which is about how many coins they mined,
Right.
but as CapEx fuel generation. This would seamlessly transition into the future section. It demonstrates that the mining revenue and BTC stack are the source of stability that allows them to pivot toward HPC data center leasing.
And you know what else? We should integrate efficiency metrics right into that discussion.
Okay.
We should elevate the importance of the $23 million in savings they realized through vertical integration, from the ESS Metron acquisition.
That's a great point.
That metric helps illustrate how efficiently they're converting mining profits into durable infrastructure assets. It shows smart, disciplined capital deployment, which is just crucial for the multi-year build-out you need to monetize 2 gigawatts of power.
That makes the whole narrative flow, from success to strategy to execution, all in one unified whole. I like that.
Good. Now let's turn our attention to the long-term AI thesis. The argument here is that the AI pivot is highly compelling, and it cites the 2 gigawatt pipeline, 2,000 megawatts of secured power, as arguably the company's most valuable asset in an energy-starved AI world. And it sells that long-term stability story really well.
It does, but we need to ensure the robustness of the claim.
I see the strong conviction, but I wonder, is there a risk that focusing just on the massive upside might overlook some crucial execution challenges?
That's where I was going. While the AI pivot is a compelling long-term thesis, strengthening the analysis requires addressing the potential limitations, the competition, and the execution risks inherent in monetizing that much power capacity.
The weakness, then, is that the material is currently, it's overwhelmingly bullish.
Very.
It lacks that critical context on the practical challenges of converting raw power capacity into high-margin HPC revenue, especially against established data center players like Equinix or Digital Realty.
And that omission, it creates a potential vulnerability in the long-term stability claim, right? It makes the strong buy conclusion feel a little unsupported by a full risk assessment.
So to strengthen the analysis, the suggestion is pretty simple. Introduce brief, constructively skeptical questions or counterpoints.
Right into the body of the analysis.
Exactly. This validates that the material has considered the competitive landscape and execution risk, and that hardens the strong buy conclusion. It shows the author isn't wearing rose-colored glasses.
That's a really strong approach. So instead of just stating the 2 gigawatt pipeline is the most valuable asset, we could ask a probing question right after.
Like what?
Something like, that's clearly laid out. I wonder, though, if we've considered the execution timeline for transforming 2 gigawatts of raw, available power into contracted, revenue-generating, specialized AI data center capacity.
And you can elaborate on what that execution actually means. We know building out specialized facilities for high-performance computing servers for AI is incredibly complex.
It is.
That timeline requires procuring specialized cooling, high-end security, massive power distribution systems. That whole process takes time, and the material needs to acknowledge that lead time to market.
Absolutely. And when discussing the stable, high-margin revenue goal from those premium customers, we need to explore potential limitations. We could ask, Is there a risk that focusing just on power availability might overlook the demands for advanced liquid cooling, high-level security, and the specialized hardware needed to attract those premium HPC customers?
Integrating those concerns shows a genuine understanding of the highly competitive data center market. And furthermore, we should use the analyst notes not just for the aggressive price target, that 98% potential upside, but to integrate details that provide some grounding.
You mean like
Like analyst notes detailing the cost of capital or the time to market for the 112 megawatt Corsicana expansion. That adds necessary texture and anchors the aggressive growth phase, which is vital for long-term conviction.
By injecting this proactive risk assessment, the final strong buy recommendation becomes significantly more credible.
Because the author has shown they've quantified and accounted for the challenges.
It transforms the piece from just highlighting upsides to providing a definitive analysis based on a balanced view of operational strength, strategic funding, and, of course, execution risk. This has been a fascinating look at an incredibly strong report. So to recap for the listener, we focused on 3 key areas to really maximize the impact of this analysis.
Right.
First, we need to refine the financial narrative, make a sharper distinction between the core operational performance, highlighted by that record $197.2 million adjusted EBITDA, and the non-cash fair value accounting impact from the Bitcoin treasury.
Lead with the operational win.
Always. Second, we need to improve the structural flow. Ensure the massive $2.2 billion BTC stack is positioned explicitly as the direct self-funding engine, or CapEx fuel generation, for the AI and HPC expansion.
Seamlessly connecting the present to the future.
Exactly.
And finally, to bolster the robustness of that AI pivot, we need to integrate some constructive skepticism, address the execution risks, the timeline for converting 2 gigawatts of raw power, and the competitive demands of attracting those premium HPC clients.
The submitted material is already excellent. I mean, it provides a convincing case for the company's pivot and its massive beat. These 3 suggestions are really just aimed at transforming it from an excellent report into a definitive, institutionally robust analysis.
We encourage you to implement these refinements and submit your work back to us for another look. We look forward to seeing the next version.
Until next time.